Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello and welcome to Business Line's State of Economy podcast. I'm Lokeshwarri and I host a series looking at the global economy. Our guest today is Devang Shah, Head of Fixed Income Access Mutual Fund. We will be talking about the Fed pivot, the likely stance of US Fed in the coming months, and what ECB and other central banks are likely to do in this podcast. Hi Devang, welcome to the Business Line State of Economy podcast.
Hi Lokeshwarri. How are you?
Yeah, doing good. So in the beginning of 2024, markets were expecting aggressive interest rate cuts in the second half of 2024. But now the Fed rhetoric is shifting to keeping rates higher for longer and maybe well into 2024. So what is leading to this change of stance? And also yesterday, I think that the GDP reading for Q1 was pretty weak. So do you think again Fed will be rethinking?
Yeah, so actually good question, Lokeshwarri. On I think the bond market dynamics have seen a significant shift or a swing in expectations over the last 3 to 4 months. And you rightly highlighted that at the beginning of this calendar year or just in Jan 2024, markets were expecting around 6 rate cuts from Fed in this year or in the next 12 months. And today, if you look across at the rate cut expectations, it's probably less than 1. So our understanding is what has led to this is obviously there are two prime reasons. One is a slightly stronger than expected macro data. I would say also one more reason which has actually led to fears of resurface of inflation again is the geopolitical risks which have cropped up. You look across, there has been a lot of noise around the geopolitical risk, rise in crude prices, again supply chains can get impacted, and the combination of both the things, be a slightly stronger data on US. You look across at the CPI trajectory, it has come slightly above than market expectations. You look at the unemployment data, general expectation was unemployment will rise. We have not seen much increase in unemployment. And lastly, when you look at the growth data also, I think the people anticipated a lag impact of higher interest rates should slightly start weighing down on the growth. But we have seen good amount of, I would say the number of growth is still strong, where GDP growth is good, and hence market has started to reprice the rate cut expectations. If you look across at the Fed commentary or the Fed dot plot, till March, they were still pricing in 3 rate cuts in this year. Our belief is getting into this April end policy and into June policy, Fed will tone down the rate cut expectations. Answering your second bit on the growth number yesterday, so if you look at the internals of the growth, it is more about the external growth, which is weak in US. The internals of growth are not that weak. Investment cycle, consumption, even if you look across at the core PCE number, it was higher than expected. So I would say the trend on US data is still lower. If you compare last year, the inflation was 6 handle. If you compare 2022, inflation was a 8 to 9 handle in US. Today, if you look across at the headline, it is 0.3, 0.4 month on month, which translates into incremental projections of 3.5 or 4%. The problem is we are not getting to the target of what Fed wants. Fed wants the inflation target to be closer to 2%. We are still hovering around 3.5, 4%. And hence, I think Fed movement on rate cuts would be limited. Their guidance would again probably be slightly more, I would not say hawkish, it would be neutral, where they would guide the markets for not significant rate cuts in this year. Our estimate is we might see still one rate cut in this year, 1 to 2 rate cuts in this year. But on an overall perspective, I think the stronger data has led to this swing in expectations from significant or aggressive rate cuts to now higher for longer.
Okay. So what does this do to the bond yields, Devang? Because it's beginning to harden, rise from what I see. And will it again go past the 5% level, the 10-year US?
Good question. I think, if you ask me, the bond yields are already at 470. We have always been communicating that these are record high levels. There are reasons why US treasuries are trading at these levels, and it is important for investors to know this. When in our, I would say in the last 20, 30 years, where we have seen US inflation higher than India inflation. Okay, today also when you look across at the core inflation, India core inflation is now at 3.2. US inflation is very close to it. If you look at the entire last year, a part of 2022 and major part of 2023, US inflation was higher than India inflation. Secondly, US has been running on a significantly higher fiscal deficit number. If you look across at COVID, they were running at 9% to 10% of fiscal deficit of GDP. If you look at last year, last 2 years, they've been running across at 6 to 7% of GDP as fiscal deficit. So it's significantly higher. You look at the growth numbers, there is 3%. You're talking about fiscal deficit, which is 2x of growth. You look across from a perspective of emerging markets. Emerging markets like India are probably running at 5% of fiscal deficit. US is running at 6.5. So when we're looking at the macro data in US, the US is actually going through a typical cycle of higher inflation, slightly higher inflation, probably significantly higher fiscal deficit. And thirdly, the disinflation has been at a slower pace. The last bit of disinflation, which Fed is wanting for, I think probably is a bumpy ride. And hence, rate cut expectations have got massively delayed. Impact of that has been that you have seen a rise in bond market yields. At the beginning of the year, 10-year USD was trading at 380. Today, you are trading at around 460, 470 levels. Today, as of now, the live levels are probably 470, 71. Our expectation is we are at the peak, near-term peak, or I would say on a medium-term perspective, we are very near to the peak on the US Treasuries. At these levels, genuinely, if you ask me, financial conditions get very, very tight. Impact of this can be, if it tightens massively, we have seen in past, it leads to accidents. So our thought is, yes, it's been a bumpy ride. It is volatile. Growth data is marginally positive, but the extremity of which the sell-off has happened in US Treasuries, I think is slightly overdone. Though we anticipate that probably there can be a 10-15 basis more upside from current levels, but I think US Treasuries to trades massively above 5% or Fed to change its course of cuts to hikes, I think it is probably asking for too much. We don't anticipate Fed to change its course and start hiking rates, because today also, when you look at 1 year hence inflation expectation, you add some bit of volatility on crude, the inflation expectations are close to 3.5 to 4%. Today also the Fed operative rate is at 5/4, 5.5. You look at the 10-year treasuries, they are trading at 470. They're already having a risk term premium. So from our perspective, I think at these levels, a lot of negatives of US markets are in prices, and we don't anticipate, except a near-term volatility in bond markets, we don't anticipate a significant rise in US Treasury yields from current levels.
So does that mean that you're saying it's going to peak? So the yields will come down from here, or you think it will just stay elevated at these levels? And also, what will it mean for our Indian GSEC yields? Because there's some kind of a correlation between the two, right?
See, our belief is obviously markets would need to, as I told you, markets have swing from one extremity of 6 cuts to now almost going to 0 rate cuts, and probably markets have started talking about rate hikes. Markets have started talking about expectations getting built in that these rates will last for significantly longer period of time. Our belief is, as I told you, look at the history, look at the trend. The moment financial conditions get tight, the impact of that in US markets on growth is significantly pronounced. And hence, our belief is we are already getting in that version of tighter financial conditions. And hence, we anticipate that economic data, both on inflation and growth, to start showing lower trend and probably showing some bit of slowdown. With that, incrementally, we believe that obviously it's not that we are expecting too many rate cuts from Fed, but I think probably we can look at a couple of rate cuts in the next 6 to 9 months from Fed. Markets, our perspective is that US Treasury for the near term will, because you have seen a lot of volatility, you have seen significant rise in yields in a short span of time, some bit of pullback on yields is very much possible. We believe US Treasuries will trade in this wider band of 4 to 475, a narrower band of 420, 460 for some point of time. You are right. To answer your second question, you are right that there has been a correlation, or developed market bond market yields do have an impact on emerging market yields. But if you look at the last 2-3 years, there has been a lot of disassociation with what is happening on US treasuries and the impact of that on Indian bonds. Let me put it across to you with numbers. If you look across at Indian bond market yields, they peaked in June 2022 at around 760. If you look at that point of time, US treasuries were trading just around 3%. In the last 18 months or 20 odd months, we've actually seen US treasuries increasing from 3% all the way to 5%. And when you look across at bond markets in India, we've actually seen a downward trend from 760. I think the year 23-22, we saw yields trading in the range of 740, 760. When you look across at 2023, we saw bond markets in India trading, specifically 10-year GSEC trading in the band of 720, 740. And now, when we look across at bond markets in the year 2024, thanks to fiscal consolidation, thanks to our Indian bonds getting included in JP Morgan indices, the trend or the range for Indian bond markets, 10-year GSEC specifically, is in the band of 7.25. So I think despite a 150 basis rise in bond market yields in US treasuries, we have actually not seen much impact on our bonds. Even if we see some bit of near-term volatility, obviously you see some bit of volatility in our bonds. We might see Indian bonds trading in the narrower range, some upside in bond market yields is possible, yes. But directionally, our bonds or Indian government bond yields will be much more dependent on the inflation outlook, on the growth outlook, and somewhere down the line what happens on the external situation. Our perspective, when we look across and we stress the scenario on inflation also, we believe inflation for the near term and the next 12-18 months will hover around 4 to 4.5% in India. With that kind of inflation trajectory, focus then shifts on what's happening on the external side. You look at the amount of reserves which RBI has built in the last 3 to 4 months. We are again probably at all-time high reserves on FX, 650 billion plus of reserves. Our external situation is very, very strong. Thanks to our bonds getting included in JP Morgan indices and Bloomberg emerging market indices, we are probably going to get 20 to 25 billion of flows in the next 12 months. That provides a lot of cushion to our external situation. So with the context of external situation being comfortable, India's CPI trajectory looking over a medium term closer to 4.5 to 5%, we believe that even though we see some bit of rise or volatility in US treasuries, we will not see a significant impact of that on our bond markets. And again, as I had answered in the first question, that there has been a lot of disassociation with US bond markets because US macros are going through a different cycle. We have not seen such high inflation in US before. We have not seen such high fiscal deficit in US before. And hence, I think there is no direct correlation left. In fact, correlation is significantly less. And we believe even if there is near-term volatility in US bond markets, directionally, our bond markets will trend lower. Currently, we will trend in a range of 7 to 7.25 for the Indian 10-year bond yields.
That's very interesting, Devang. So is it just India, or is it like the bonds of all emerging markets are kind of delinking from the US bond yields?
I would say, see, to a certain extent, we have seen a large part of disassociation or delinking with US bond yields, because emerging market bond yields have not seen so much of sell-off as US markets. And let me give you again some reasons why probably we have not seen such massive rise in bond market yields in some of the emerging markets. I think when COVID happened, every economy addressed the COVID situation differently. If you look across at the US, the amount of fiscal expansion and liquidity injection was very, very high. If you look across at India, we were always measured in our measures of liquidity injection, rate cuts. We have not done as much because it was not required. Our growth trajectory came significantly faster. Developed markets did a lot of fiscal expansion, did a lot of liquidity injection, and significant easing on monetary policy. So the reversal was also very aggressive. they have not been able to pull out of the fiscal expansion. So they're still continuing with the fiscal expansion. So our perspective is US treasuries are trading at higher levels is because of differentiated inflation, very high inflation for last 24 months. Secondly, significantly higher fiscal deficit. In emerging markets, I think if you look across at China is going through its own problems of slowdown. You look across at some markets like Indonesia, India, we have had significantly faster growth. We didn't have so much of fiscal expansion, and hence our bond market yields are somewhere down the line not as exposed to incrementally to the movement of US treasuries. There is some linkage because generally dollar strengthening leads to external situation getting weaker. Your currency shows some bit of volatility and central bankers get worried. But incrementally, it is not as linked as it was in the past. When you look across the decade of 2008 to 2018, I think the correlation was significantly higher. Now it is significantly less.
Okay, that's very well explained. Thank you. So let's look at the other global central banks, such as the ECB and all that. So do you think they'll be waiting for the Fed to cut rates before they do, or do you think some of the central banks of G7, they can move ahead of the Fed because each of their economies have different dynamics and different requirements. So, what is your view? You think they'll all be waiting to toe the line that the Fed takes?
No, I don't think so. So I think probably you rightly highlighted Lokeshwari. I think to completely agree with you on that. A lot of economies are going through different cycles. If you look across at China, they are significantly in pain. When have we seen such kind of slowdown in China in the last decade? I think last 3 4 years we have seen massive slowdown, but that's been a cycle across after COVID and the markets anticipated slowdown. But I think China has continued through its entire growth slowdown phase even right now. Secondly, if you look across at Europe, a large part of Europe has started showing slowdown. You look across at, in fact, if you look at the other developed markets like Japan, they are much more stronger on the growth side. So I think you are right. I incrementally global central banks will be significantly dependent on their local macro environment. The local macro environment at this point of time is behaving differently for different economies. I think Europe is started showing massive slowdown. So if you ask me, can ECB cut before Fed? I think very high probability of ECB cutting before Fed. Secondly, our understanding is China might look at policy incremental dovish policy measures very soon. They've already done reserve ratios like in India, which is called the CRR cuts. They've already done reserve ratio cuts in China. We can see that. So our understanding is incrementally there is a very high possibility that other central bankers can look at rate cuts before Fed because Fed is going through a different cycle on growth and inflation.
So let's talk about RBI then, Devang, because typically we have seen that they have followed after the Fed starts hiking or cutting, they follow the Fed's lead. So what will RBI do this time, do you think? Because I think the consumption is slowing down. There are some indications that the interest rate hikes are beginning to impact some loan offtake and all that. Do you think RBI may move ahead of the Fed?
Interesting question, Lokeshwari. So if you ask me, see, first of all, to correct you, RBI did stop hiking rates before Fed. Okay, so they stopped hiking 6 months before Fed, if I'm not mistaken. So RBI has demonstrated that be it rate hikes or somewhere down the line rate cuts, they can't do it independently depending on their macros, local macros, how the macros behave in India. As I told you, I think today RBI is in a very, very comfortable situation. They are looking at the inflation trajectory, which is significantly showing a lower trend. If monsoons are normal, we don't see any kind of geopolitical risk leading to crude shocks. I think can RBI start looking at changing its stance? Very high probability. For the rate cut, I think they would want to be sure and confident about two aspects. One, that global inflation or somewhere down the line, the inflation theme is not coming back. Second, more important aspect, is that the geopolitical risk settle down. Third, I think they would also want to be sure about the normal monsoons. If these three are taken care of, and in the second half, as all of us are expecting, the inflation trajectory continues to be on the lower side. I think there is a very high, and for some reasons, if US continues with its higher for longer stance, can RBI look at a token rate cut before Fed? Possible. I would assign a lower probability to it, but it is very much possible because our macros and the risk which RBI is highlighting today, if all of them are covered, RBI can definitely look at it. We believe the way the situation, we are not experts on monsoon, but we believe the way the situation is today, I think if we get a normal monsoon and the crude shocks are not there because of any kind of resurface of war, we believe the second half inflation trajectory is seriously close to 4%. And hence, there is a possibility of RBI to change its stance and guide markets for rate cuts. Once RBI changes its stance, even if RBI doesn't cut rates, I think markets will be guided that probably RBI can look at cutting rates. And you will see a 25 to 50 basis of rate cuts getting priced in Indian bond markets.
But isn't there a worry of outflows from India if we start cutting and they're higher? That's what has been holding RBI back, isn't it? The external situation and the impact.
Definitely, Lokeshwarri.
Yeah.
So, sorry. Definitely, Lokeshwarri. I completely agree with you. RBI wants to be cautious. So, as I'm telling you, RBI has done a superb job on managing the external situation. I think to give them we should all give them a thumbs up the way they have managed the external situation at this point of time. The rupee stability. If you look at the last 24 months, we have seen bond markets volatility, rupee volatility massively across developed markets and emerging markets. Out of which, if you look across at the way RBI has managed both bond markets and rupee, I think probably it's a superb job done by them. From a perspective on at this point of time, where there are global risks, specifically a geopolitical risk on inflation, crude, I think RBI would want to be cautious. That is why I told you in the next 3 6 months, 3 months specifically, RBI would want to one first look at the monsoons, be sure that there are monsoons are normal. Secondly, the geopolitical risks settle down. And the third thing, the inflation theme globally doesn't resurface. If the RBI gets confident on it, then I think depending on the macros, and our view is, even RBI's view is, that second half inflation is significantly under control. At that point of time, they can look at rate cuts. To just give you some more color on the disassociation with the global markets, I think we all need to one agree on. I think one perspective. Last year, when US was hiking rates, people were always worried about the interest rate differential between US and India. Okay, it's currently also at its all-time low, and people thought we will get massive outflows in from India, and people will be investing left, right, center in developed markets. But that's not been the case. We've actually got inflows. You look at debt markets, you've got 10 billion of flows. You look at equity markets, you've got massive inflows. You look also at the number, despite all the lower interest rate differential, US hiking, US treasuries at 5%, different kind of geopolitical risk coming across, India is still outshining other economies because of the strong relative growth, strong political mandate, and significant stability on the external side, which is managed by RBI. So our perspective is that even if we see some bit of volatility, even if we cut rates, it will be dependent on our macros. If inflation is significantly lower than RBI's expectation, if we start getting, as you pointed out, some sectors have started showing a bit of slowdown. If we start getting some growth shocks internally, and RBI believes so, it is important to manage growth because the reason for we standing out on flows and at this point of time on the external sector is significantly because of the outperformance on the growth side. So they would not want to unnecessarily, by keeping rates higher, kill the growth story for India. So our perspective is, if all the risks are taken care of and inflation trajectory is around RBI's target of 4 quarter, RBI can look at cutting rates and it will not lead to any kind of massive outflows, as I explained you in the last year also, despite narrowed interest rate differential, because of our growth outlook, because we being proactive and strong political mandate, I don't see any kind of risk, massive risks on outflows.
But the inflows in the last 1 year are also because of the bond index inclusion that you indicated, right? So, do you think that's enough to cushion any outflows that can happen if RBI takes a different stance from the Fed?
Definitely. See, we look across at now the see also RBI is being able to manage the currency well. I think what we understand always by whenever RBI has spoken about this into monetary policy meetings, they don't want unnecessary volatility on rupee. They have a huge cushion of reserves with their buildup. See, general expectations of market was that dollar will weaken, rupee will massively appreciate. And we got a lot of inflows in the last 3 6 months. We've got equity market inflows, we have got debt market inflows. But RBI has not allowed currency to appreciate. RBI has always kept on building reserves. So our understanding is if we see some bit of outflows, you have first a cushion of 20 25 billion of flows coming in because of debt markets that JP Morgan inclusion will lead to, because those are passive flows. Large part of it is replicating passive strategies. So our understanding is that flow is sure to come. With the 20 25 billion of flow coming in, I think it provides a lot of cushion for some bit of uncertainty, and we don't see any major impact on the external side.
Okay, all right. The final question. So, what is the strategy that you think that the fixed income investors in mutual funds should be looking at this juncture, given the view on the interest rates and everything?
Yeah, so see, we had actually called out for three themes at the beginning of 2024, and I think we still believe so that all the three themes are at play. Okay, and we believe so that at this point of time, the first important message to the debt investors has been that you should be allocating or having a higher allocation to fixed income at this point of time. The reason being a lot of negatives on fixed income markets are priced in. When you look at the macro specifically, as I highlighted, peak of inflation is behind us. You're looking at inflation lower. The pace of fall in inflation has been bumpy, or the ride has been bumpy. But if you look across at inflation trajectory, it is actually on the lower side. So the first important message from our side is that we are at the peak of the inflation cycle. We believe incrementally growth everywhere will slow down. And looking at RBI's and India's external situation and the way RBI has managed the external situation, I think at this point of time, it is very important to understand that we don't see any kind of major impact on the external side. Current account deficit is significantly under comfortable. So all the macro points augurs well for bond markets. We are advising clients to not only increase their allocation to fixed income, but also increase the duration of their portfolio in fixed income investments. The second important theme which we called out for is that not only macro, if you look across at the demand supply dynamics in this year, thanks to lower fiscal deficit number, I'm sure everyone knows government has done a fiscal consolidation. Last year they were borrowing 5.8% of fiscal deficit. This year it's 5.1. Next year they will go to 4.6. So in 2 years, you've actually done a significant fiscal consolidation. We also have JP Morgan, because of JP Morgan inclusion, we have 20 25 billion of new buyer category in this year, which will translate into a favorable demand supply dynamics for bond markets. Our assessment is at this point of time, when you look at the demand supply dynamics, it is significantly favoring the demand situation, and supply being stable. We believe that that's the second reason why bond markets in India will rally. The third important aspect is that RBI slowly and gradually, so I'm sure you're aware of that August 23 to February 2024, RBI had kept the liquidity very tight. RBI has started to shift its stance on liquidity and move from 675 operative rate. So they didn't do a rate hike. They just made the liquidity in the banking system so tight that your effective rate moved up from 6.5 to 675 from August 23 to Feb 2024. Currently, when you look across at things, RBI is proactively managing liquidity and keeping the operative rate closer to 6.5. So our assessment is, if you look at all the three factors, which is one, macro, second, demand supply dynamics, and third, the liquidity stance change. I think it is significant reason for bond market investors to not only add fixed income to their investment portfolio, but also to increase duration. From a fund category perspective, to medium-term investors, we are actually advising them short to medium-term funds with some kind of allocation to gilt funds, which will help them to get a better return over the next 12 to 18 months. We expect yields to trade 10-year bond markets to trade in the range of 675, 6890 band in the next 12 to 18 months. Secondly, we also expect at least 2 rate cuts in this cycle, taking the operative rate from 6.5 to 6% in the next 12 to 18 months.
Okay, thank you. Thank you so much, Devang, for sharing your insights. I'm sure our listeners benefited a lot from this. Thank you so much.
Thank you, Lokeshwarri. Thanks for having us.